All right, welcome everybody. We're take a few more minutes to let a few more come in and able to get their audio going. Everybody, we're waiting about one more minute here to let a few more get in and make sure that they are all set up with the audio. And so for those of you joining, it is a webinar, so you will not have audio and you do not have your video that will show up for us, but the chat function works. So if you want to talk in chat, you are free to do so. And we have also started recording if it did not already announce that to you. A few more minutes and we will go. All right, everybody. Well, again, I'm going to share my screen. So welcome to everybody. This is Jake Dooley. I'm the pre-deployment program manager here at Local Vest. And this is our inaugural pre-deployment webinar. So the first one that we hope to be of many of getting together once a month and talking about some different topics that have to do with issuers. As most of you know, Local Vest, we make it very easy for veterans to invest in veterans. A lot of our content, the video content that we put out each month, really focuses on really getting investors excited about issuers that are putting deals on the platform. So it's a lot more about making investments. Not a lot of them are like this program where we're going to talk more about to you as an issuer, things that you need as an issuer. And so we're going to introduce today the pre-deployment program. I want to talk a little bit about that before we get into content with Scott. So for every deal tile that you see out there and different investment that you can make on Local Vest, there's a lot of you who aren't quite ready to raise capital. There are a lot of issuers or potential issuers just like you, and they're asking a lot of questions. Questions like, am I ready to go? Or am I regulatory compliant? You have a question that you want to ask an expert, you don't know where to find that expert. This program, the pre-deployment program, is meant for you. Just like when you get ready to go out, and you were in, all of us here being in the military, when you were getting ready to deploy, you had pre-deployment. You did your workups. You went to training, you learned the language, you learned the lay of the land. You got to practice a lot of things before you were actually out there live. That's what this is about. We're creating a community of issuers that are going to get you ready for your race. So each month, we are going to have discussions just like this one, bring in experts just like Scott, and then you're going to have a chance to do some follow-on office hours. So it means we'll talk about that at the end, but you'll have a chance outside of this forum to be able to ask questions one-on-one with Scott and the other experts that we bring in. We're going to record all of them, so if you miss one, absolutely fine. You're going to be able to go back and get it. We're going to make a repository of a lot of the other things that are issuer related. Every single new bit of information will go in there. There's also going to be written content that we'll be able to put in there so you can try to get some questions answered. The other thing that we're going to do, I think this is fun, is I call it red teaming. So a lot of you have elevator pitches, 5-minute pitches you do in a demo day, full-blown pitch decks that you would make to investors. And you probably haven't a lot of chance to actually give an investor presentation and get solid feedback. Sometimes there's not a lot of talking afterwards about why something went well or did not go well. We're going to give you the chance to sit in front of people who listen to pitch decks day in and day out. So fund managers, we'll bring in some angel investors, people who just see a lot of these day in and day out. And frankly, they're going to rip them apart, tell you what was good, what was bad, where you're strong, where you're confusing. and hopefully allow you to take those pitch decks and that presentation material and turn it into something that you can use so you can be successful. The other thing that's not on the page is the aspect of being a part of a community. So anything that we come up, a particular topic you want to discuss, let's say you have a question, you want to talk to an expert, there's something that you don't understand, or maybe there's something you want to do with other members of the community getting ready to raise, you'll be able to bring that up. We'll go find those experts for you, and you can consider this community a safe space so that when you are out there ready to try to raise capital, that you can be as successful as you can be. So that's what the program is about. There's going to be more links, some more emails that will come out about this program. So this is the first of many items that have to do with the pre-deployment program. So welcome to all of you. I'm glad and excited that you're here to join us. All right, the way the program is going to work today, a little bit different than we normally do. Normally we give one or two groups come in and they give a full presentation. There's a little bit of Q&A at the end, and then we go out. Well, that's not what we're going to do today. This will be much more like a podcast, so a video recorded podcast. I'm going to introduce Scott here in a few minutes, and Scott and I are going to have a conversation. We've got some questions. We'll allow it to go. Very few slides that we're going to discuss. All right, so this is your opportunity to learn about what it's like to be a fractional CFO and how it can help your company. As I said, you cannot come off of mute. You are not video recorded unless you're one of the panelists. So that is not how you're going to be able to jump in and ask a question. So go to chat and you'll be able to type a question in there. Hopefully I'll be able to get to it. So Bill, who's normally the person who's moderating, he's going to help us out here. All right. And so if he sees something like a topic that we're doing and really wants to jump and ask a question, he's going to do it, or he's going to be pulling some of the ones off of chat. All right. But again, if we don't get to the question, that's absolutely fine. Because if we don't get to the question, there'll be opportunity. You can ask in office hours some one-on-one questions, and we can work to get those answers. So if something is left, don't you worry about it. All right. And again, as a reminder, we are being recorded. You don't have to furiously take notes the way that it goes. You can always go back and watch this presentation whenever we're finished. All right. So without further ado, I'm going to go in and introduce Scott here. So we have Scott Chesson. He is a Naval Academy class of 1984, did surface warfare. And after that, he did a master's in accounting at UNC, which is fairly unique, right, to go through about getting a master's in accounting. There's not so many who did that. Worked for IBM and American Airlines. I think we're familiar with those, but there's a few other ones that are less familiar, a lot of different companies, all on a financial basis, like Wyndham Jade, the Focus Agency, Washington Speakers Bureau, Grayling, Dutco Worldwide, and the Podesta Group. But then in the middle of COVID in 2021, this is when Scott went out and created the CFO for Vets, which is offering fractional CFO services to veteran-owned and, I should say, military spouse businesses. And that's why we brought in Scott today to talk about what it means to be a fractional CFO. So welcome, Scott. Glad to have you joining us.
Thanks, Jake. It's great to be here and really appreciate getting to talk to the local VEST community. So thank you.
Great. I will tell you, so I listened to those of you who haven't, I guess it was late last year as you were getting started, and I guess it was on the SABM podcast with Scott. So I listened to that the other day and got your full background. So any of you want to know the full background with Scott and some of the things, it's a great way to do that and listen to that interview on Scott's podcast. But the question I want to ask you too, and just a little bit on the background, is, we're familiar with IBM, American Airlines, but some of these other companies, like essentially these other companies that were not household names to go through, what kind of industries were they in, and what size of companies were they that made them different from these big ones?
Yeah, post-American, I was a controller for a company called Wyndham Jade. It's in Plano, Texas. It was probably $100 million and had 6 different lines of businesses. It's one of those that just kept adding, either buying, acquiring, or started up different LOBs. After that, I went to the Focus Agency, also in the Dallas area, and that was an advertising agency. It was a small advertising agency, and that was owned by Omnicom. And so my next gig after that one, and I I'm a veteran and son of a veteran, so I tend to get itchy feet, or at least I did when I was working. So once the challenge is complete, I go on to the next one. The Speakers Bureau was just bought by Omnicom, this big marketing advertising conglomerate, and it's in this area where I live, in the Northern Virginia area. And it's a talent agency for speakers, and probably gross revenue is about $150 million. And after that, a couple others. Grayling Dutco was a company, it was private equity owned, a lobby and PR firm that was bought for about $40 million out of private equity. The Podesta Group, I ended up going to a competitor that recruited me over. That was another $40 million business or so, lobbying and PR firm. And then my last stop was the Spectrum Science, which did health. It was really a full service marketing agency, but specialized in doing healthcare PR communications, really a lot of pharmaceutical product comms and crisis comms and some other things in the healthcare PR space.
So what made you choose to hang out your own shingle and say, you know what, I'm going to start CFO for vets?
Well, at this time, it was beginning of 2020, right before COVID, I had been doing the CFO gig for 21 years for those 5 businesses, and I was actually a little worn out. And I've been thinking about hanging up a shingle for 4 or 5 years. And then I finally said, that's enough. Let me take a few months off. This is before we knew about COVID. I'd already decided to do this. So I left that firm at the end of March. It was coincidental timing. My last day in an office, March 11th of 2020, like a lot of us, right? And
right.
I took a couple months off. And then I decided I wanted to start my own business, consulting, fractional CFO consulting, to kind of go back and help small businesses who don't need a full-time CFO, right? Mm-hmm. And once I started it, I really, being a veteran, a son of a veteran, my mother was actually a veteran and a military spouse. So I have this great affinity for veterans and military spouses. And I just decided to focus my business completely on veteran-owned businesses and military spouse businesses, because it's just a passion for mine to give back to the community. It's been a big part of me for my entire life. And I wanted to give back and to that community, and I enjoy work. And again, it's just a great fellowships, and there's a level of trust working with fellow veterans and military spouses.
And so then what exactly does a fractional CFO do?
Well, I look at it as, in your typical business, as you grow up, you start off, maybe you have a bookkeeper kind of to keep score, track, here's what's going on in the business. You're really just retroactive scorekeeping, right? Then you have an outside CPA is to minimize tax liability. And at some point you get beyond that where you need more strategic finance help. How do I grow the business? How do I scale it and grow it profitably? How do I become much more forward thinking about my business instead of, oh, I have enough money in the bank to get through the next 2 payrolls or through the next month. I'm really thinking, I want to be forward looking. And so that's when you really need a CFO. It's much more strategic. You want to get into key performance indicators and analyzing your business and what is really making your business tick financially, and how can I make it very efficient financially, using resources, generating profits and growing. And then obviously at that same time, you're improving the value of your business. You're growing the value of your business while you're doing that.
And when you talk about, like, at what stage, like a lot of people are doing, is it the right time to start thinking, maybe I should bring a fractional CFO in to think about some of these strategic things with me?
It depends. I've helped a couple of startups. Originally I wasn't going to do that, and I'm maybe stealing the thunder of later. Usually a lot of times they'll say, well, we'll offer you equity for your services. And I always try to discourage them from doing that, from diluting their ownership interest by paying for services. So I usually don't, but in one case I helped the person, the military spouse was fundraising. They were getting ready to raise capital. So they really needed help kind of positioning themselves financially, good financial projections and reports that would make sense to investors and be easy and look the part. So I did that, and I'm helping another startup now who it's the same type of thing. It's a much lesser, budgets, forecast, and just helping them kind of position the business and understand the business financially, getting them started more than anything else. So, but generally, 2 to 20 million is a good revenue wise is a good entree point for a fractional. Below 2, usually there's not quite a need for it. Above 20 million or above, there's often a need for a full-time CFO. And it may be, again, those are approximate ranges. They can vary.
Even if it's before that and you're getting ready to do capital, like you're saying, sometimes it can help just putting things in a format to say your format that you're seeing is not familiar, and help them make a framework that looks, I guess, more relatable to your average investor who may be coming in.
Exactly. You want it to be very, very professional. Everything you do, obviously, when you're raising capital, you want to have your game face on. You want to do it incredibly professional, look like you've got it all together, all parts of it, including the financial presentation. And again, I always look at it, raising capital. It's just like it's when companies go out to go public, to get traded on a public stock exchange, they go out and do a roadshow for initial public offering. They're going out, they're telling a story. They've got to have that story down pat. What are the financials? How am I going to grow the business? What's the size of the market? So you're doing the same thing when you're raising capital at the startup. You're telling a story on what you're going to do, what problems you're going to solve, but you want to make sure you can make it relatable and understandable to the investors, because you know it inside and out, but they may not. So you want to present it in a very clear, coherent fashion.
Okay. Now there's these other terms I was getting here, like treasurers, controllers, other financial names. At what point does, someone who's starting up a company need to be thinking about these other roles that have to do with finance?
Treasurers really, for me as the CFO of those businesses, they were from, 20 million to 150 million. I was always the treasurer too. That's the guy who manages the money, the cash flow, whatever the debt, the lines of credits, and everything else. Those are usually bigger publicly traded companies that need that. Like I said, I referred to the Omnicom. They had a full-time treasury department just to try to manage the cash flow for a $10 billion company, but that's something generally for large companies. A controller is like, it's kind of a chief accounting officer, but that's really something, again, too, for a larger business, not necessarily for a startup. You don't really need that. You need a bookkeeper. Maybe you need a little part-time CFO help. Maybe you don't. The other thing I tell everybody is, don't forget, there are small business development centers in every state, and you can go and get a lot of help, whether it's with your pitch, putting together a budget, a business plan, all that. You can go to those places as well to get help, and it won't cost you anything. So that's a way too, if you're kind of like, I need some help getting started and with some of this without paying for it, and I'm on a shoestring budget, then you can go there and get some good help from each one. In Virginia, I'm in Virginia, and there's a whole bunch of offices all over the state. But that's what they're designed to do, is really to help the small business entrepreneur get going, get started with some of their basic nuts and bolts.
Great. Well, let's go into some of those nuts and bolts to go through. So the ever popular question when it's time to raise, how do I determine how much capital I need to go out and raise?
Well, that's a good question, because you have to kind of, and this is about modeling it out, right? What am I going to do? First of all, why do I want to raise capital? Why do I need it? And then second of all, how am I going to use it and deploy it? And how long do I think it's going to last? I guess there are a couple of different things. You don't want to ask for too little, because then you'll be constantly fundraising. So you'll run out of it too fast before you can probably properly deploy the first part. And then you don't want to ask for too much, because when an investor gives you money, they expect you to deploy it and make magic with it, right? To make things happen. That's the whole idea. Is I'm entrusting you with this money to deploy it and make it work, make the business grow, generate revenues, whatever it is. So I always say, you kind of probably want to have a 12 to 18 month plan with your first raise and say, okay, how long is the cash? Is it going to last? And maybe the capital lasts beyond a couple of months beyond, 12 months or so, something like that, before you have to go back to the. So you really kind of have to model it out. Cash flow. How am I going to spend it? What am I spending now? What do I need to spend? How am I going to spend those resources, and what is it going to generate to determine that? But I think it's always a little bit of a delicate act between asking for too much and then asking for not enough. You obviously want to ask for enough to get beyond, so before you have to do another raise.
All right. So if I'm out there trying to maximize cash flow, you're saying, like, so what kind of levers do I have out there when it comes to raising capital and along that string of business development to help manage that cash flow?
I think that, there are a lot of levers. You've got credit cards. Clearly, that's high. Those are high interest rates. But you can use those. Business credit, usually in that fashion, is readily available. A lot of times you're gonna have to do a personal guarantee, but at least you can leverage your own personal capital or financial statement to do that. So there are credit cards, there are bank loans, there are private loans, there are different ways that you can do that. If you do credit, the reason I recommend credit cards, particularly for spending, is it gives you some float. Usually, if you spend something at the beginning of the cycle, you may get 55 days before you have to pay for it. So you want to maximize your float, for sure, because you're dealing with a shoestring. You don't want to pay for things immediately and then run out of cash that way. So that's one way to do it. I think access to bank lines and loans, if you can get them. I know they're not always easy to get, and it probably become more difficult because, as we've seen with interest rates, they went from 3% or so a year ago to 5.3% on the 30-year in like the last 12 months. So capital will probably become a little tighter because interest rates go up. But that's what I mean. I think that kind of describes basically. You have to just be very smart with how you deploy your cash flow. You have to watch every penny, and you have to maximize the float. The other thing is, through these small business development centers we're talking about, sometimes they have access to grants. They can help you apply for grants, SBA loans, and other areas where you can command some capital or try to go after some capital before borrowing some, or before borrowing or investing, getting investors into your business.
So a few things, I see a few comments. I know, some people making comments about the SBCs. There's different areas, and there are some that are veteran focused. Almost everything that out there has to do with almost any type of business operating. There are veteran focused groups that can help you out. And I just want to confirm in here too, we're saying Scott weighs it actively involved and says bringing in a fractional CFO, even if it's early. You mentioned the 12 to 18 month runway, which I think is good. But, each business is very different. Is it fair to say that that's one of the things that you or a fractional CFO could help out in that strategic idea about saying, okay, here's how much would be the right amount that you should go for, and what types of leverage you could potentially use to try to do it the right way? Is that a fair thing to say?
That's a fair thing. Again, one of the biggest troubles for businesses, they struggle with cash flow, right? So you really want to nail it out of the gate. You want to forecast it, and you have to stay on it weekly and just constant. So however you can maximize it through, bootstrapping, whatever it is, but you want to forecast it as best that you can all through the time. If it's 12 to 18 months, you want to go that far out. Now, maybe it's not going to be as accurate as 18 months as it is 1 month. But and I would say not just for startups, all businesses should do that, because cash flow is oxygen to your business. And so, but deploying it, using it, and maximizing the efficiency of using it is especially essential when you're running a startup and you're running, again, a shoestring operation. But I would always do a forward-looking forecast.
So if I can counter what you said, right? So I know what your answer is to go through about if I'm cash strapped, right? You're still saying if you don't have to, don't use equity, right? So don't pay for your CFO services by giving equity away because you don't have the cash if you don't have to.
That's right.
Okay, but let's say I have to.
Yeah.
What are some things that you're thinking about? Like, okay, if you have to go that route, what are some things that you would bring up to someone who's out there issuing that equity to think about or keep in mind as they release shares instead of cash?
Well, let's assume you're own your business 100%, right?
Yeah, that's a good assumption. Your first one, okay?
Okay, so this is your first raise. So when you issue equity, you're issuing ownership. So somebody else now has an ownership stake in your company. So you're diluting your ownership. So as long as you understand that right out of the gate, that's the first thing that happens if you raise that. Equity capital tends to be the most expensive of the capital, whether it's debt capital or using retained earnings. Well, we're not going to talk about retained earnings here because we're talking about a startup. So let's say debt capital or equity capital. So equity tends to be the most. So one, you're going to give up a piece of your ownership of your business, and you'll have somebody else who hopefully will be helping you grow your business, and so there's that. You're with debt capital, you've got interest expense, you've got some tax deduction, you've got a little bit of tax efficiency there. With equity capital, you don't. You've got somebody else talking about your business, telling you what to do with your business, and then you got to remember there's a high level of accountability here. Again, somebody is going to invest in your business, and you're going to have to deploy that capital in the most efficient, smart manner possible, because they're expecting ultimately to get a return, maybe not right away, but down the line, to get a nice return on it. Maybe 15, and maybe 20, maybe 25%, whatever it is. So there's that part of it. And so you always got to be careful when you're raising capital about dilution. Just looking at dilution, how am I going to get diluted? And you sometimes hear of people, and again, not not very often, but they get so diluted after a couple of raises that they're not even the majority owner anymore. But that's usually when you don't know what's going on. You're not paying enough attention to it. And then selecting a really good partner, right? You want to partner with somebody an investor who can help you with your business in other ways. So it's just, you want to work with somebody that you will not wake up in the morning and go, oh gosh, I got to go work with them again. They're in my business. So you want to select the right partner, and there are a lot of good ones out there. But you just want to make sure you select the right one for you and your business and where you are in your business.
So if I recap it, bear with say, if you're approaching it, do you say that it's an easy way to pay for services? It's the most expensive way, and that should be at the bottom of the list to simply use it to have access to money. That's a rough way to go about it.
Yeah, I'm not a fan of equity for services. I always tell anybody that comes to me that way to try to find another way. Just hold on to your ownership and equity. You don't want to use up your equity on paying for services if you don't have to. I mean, again, there may be circumstances where you have to do it. You'd rather do it if you're raising capital. That's a different story. But paying for services, I would absolutely try to stay away from that if you can.
Okay. We shift gears a bit. I'd see there's some questions, and I had the same one when it comes to valuation. I know you did some certifications and like to do, later you've been working on how to do valuations. Now, the traditional way of like my MBA, there's a way you can pull it all out when everything's straight in front of you. But if there's not a lot of revenue coming in, or there's not a lot of assets to go, all those kind of go out the window. So how do you think about valuing a company when it's time to go out and do a raise? Says, oh, I'm going to raise at a 6 million or a 10 million valuation through. How do you think about that number, and where does it come from?
Yeah, you've got to have some basis for it. Maybe you could do maybe you're in an industry where you can try to do some kind of market comp. It may be possible. It may not be. A lot of times there's not a good comparison out there, but it could be an industry that you're in, and you can kind of maybe extrapolate what the valuation would be. that's one way to do it. You know, the traditional EBITDA multiple, you're obviously not going to be able to do that because the presumption is you don't have revenue or earnings to multiply it by. And then sometimes some schools of thought, which I'm not crazy about this one, replacement costs. If you're, let's say you're building doing software development or something like that, what would it cost to redevelop the software? But I think that's kind of that doesn't take into account any forward looking. You know, that's really just a static. It cost me $150,000 to develop this app. But it's really, so it's never an easy answer to get to. If you've got a little bit of revenue and a little bit of client base, then maybe it's a million, maybe it's 250,000 or 500,000. When you're talking 6 to 10 million, you're talking a business that's a little further along. I would say it's much further along. It's got revenues and it's got a customer base. And if you're going to raise money and you can get an investor to agree on a valuation of 6 million, then you're much further along than somebody who maybe is just getting started. Maybe their valuation is 500,000 or 250. I like to think of it as if you want to think about valuations, go watch Shark Tank and watch those guys swim all over those who have excessive valuations. I always listen, and I'm listening to the valuation. I said, "Oh, Mr. Wonderful is going to tear that poor guy or gal up because that valuation is off the charts crazy." There's no way to get there. But I mean, as a synopsis, it's not an easy thing to come up with that, but you could probably do market comps. I would say do discounted cash flows, but that's based on, you have to really be able to forecast the cash flows and determine what that is. And you may not be far enough along to do that. But maybe you've got a really good idea in the business plan, and maybe it's worth $500,000 or $1 million. That's possible.
Yeah. And then I guess, the market's changing quite a bit here on, I guess it's more of the unknown and some things we haven't seen for, I guess, since you were a surface warfare officer, right?
Yes.
Go through, when it comes to how does inflation or what the markets are doing start to affect those types of valuations that can't be based on DCF? Or is there anything that we should be thinking about differently when it comes to, I guess, in general valuations, but then also other things that you do as a CFO for a small business that they should be thinking about?
Yeah, I mean, interest rates concern me, and inflation obviously concerns me. So what is the big, I think I saw something today, said it was 9% in June. I think that's very lopsided towards energy, obviously. Energy probably makes up 2/3 of that. But so that's obviously a concern. I worry a little bit more about interest rates. Interest rates go up, trying to tamp down inflation. I mean, that's really that's the idea behind it. Interest rates go up. What that means is it's more difficult to access capital. So because the cost of capital is going to go up, the banks are going to lend. Even a venture capitalist or their sources, maybe they're going to a bank, maybe they're a pension fund. They're going to, it's not going to be as cheap as it has been, gosh, basically since the financial crisis, since about 2009. Money has been cheap for over a decade, and now that's changing. So that means that probably competition for capital is going to become more difficult, and it may be a little more difficult to access than it was before. There's the theory that you could get interest rates go up enough, you can get a good yield from that. But I haven't seen that, and I still don't expect to see that for a while. I haven't seen that since the financial crisis either, where you can invest your excess cash and get anything worth noting. But that, I mean, obviously inflation affects everything that we do. And then ultimately you just worry that it's going to lead to recession. And, that has its own set of problems. Everything will slow down. The last many years, venture capitalists with low interest rates have been looking to deploy this cheap capital, furiously searching for startups to go find it. And I think that's going to get impacted. It'll be impacted if it hasn't already.
However, I guess that's what we're all here for, right? So the more knowledge we have, I guess cash is king, right? As you're saying. So managing that cash flow, making sure your ducks in a row, because if the cash tightens, it doesn't mean there's no cash. So that just means that we all have to be better prepared as we go out there.
Exactly.
And there will be capital for those who have a good business idea and have the framework behind it, right? Which is why we're meeting here and why we're talking and understanding with veterans. You're like, hey, you need to work on this before you get out there.
That's right. It's gonna become more competitive, but it doesn't mean there'll still be people wanting to deploy capital, and they'll still be looking for good ideas and good businesses. It's just not going to be quite as easy as it may have been in the last 5 years. So exactly the reason I say that about cash too is about 80% of the time that businesses fail it's because of cash flow. So 4 out of 5 of them, at least that's a part of the reason that they fail, is because it's just you can't run the business without the cash resource. You just cannot do it. And I've worked at a few where we had really poor cash flow, and let me tell you, it's a struggle. You can't grow a business efficiently like that. You're too busy bailing water all the time, and you're not able to it's harder to look forward when you do that. But even when you're small and you're starting up, you just have to manage it, incredibly tightly and smartly. But I would say just never take your hand off the rudder, to use a nice naval term.
I never will turn down a naval term. There you go. If we shift a little bit of that CFO for vets, right? So I guess when it comes down here, if someone here on the call or join, most people are here at very early stages to go through. What can we expect of reaching out to you that first, called the first meeting, the first 2 meetings? What are you going to look at? What do we want to talk about when it comes to bringing a fractional CFO in for the first time?
It's just, to me, I should be asking a lot of questions about just trying to understand your business and the opportunity and what you're trying to do, and what you're trying to build, because that's a good fractional really has to understand how the business and how it operates. So that would be kind of the thing. Can I help you? Can I help you efficiently? And is it within your cost range, or are you better off getting started? Like I said, a small business development center where you can get it for free. In some cases, I think I could be helpful on somebody going to raise capital, or because I can help them position themselves financially and just think through it. In other cases, it may be they might just be more basic. They might want to get started, with a small business development center or something like that, out of the gate. But my sweet spot is probably, like I said, 2 to 20 million, where a company wants to grow, and they're flattened out in their growth, or they're struggling with profitability. Not only grow, and again, I always just say, not bragging rights growth where you grow 100% but your profits decline. It's scalable, profitable growth. So let's grow the business and improve the margins at the same time. That's the whole point of it. So I'm really, and when you do that, you improve the valuation of your business as well, which we all want to keep that valuation going up, because we're multiple of earnings continues to increase.
And then as a baseline, like if I'm out here, how do I get an effective use of CFO? Like how often would you recommend meeting with somebody, and some of the baseline topics, or things that it would advance prep for a conversation?
I think, again, it depends. It's all situational. Sometimes I'll just do a project. Again, the military spouse I helped, I did a project, help them raise capital, and then help them with the financial projections. You do a project, and that's it. Because again, they've got limited resources, and I was, well, let's do this. Let's help you get yourself ready to raise capital. A startup like the other startup I'm working with right now, developing an app, it's more of just kind of catch as catch can. It may be an hour or 2 a month at the most. It's not very much. Just helping them, advising them when they need it. So it can be just on demand, or it can be, we're far enough along. We kind of want to just take a look at the financials, the cash flow, and everything else once a month. Maybe you can, take an hour a month or an hour and a half a month to sit with me, or you're further along, maybe you need me 20 hours or 30 hours a month. Again, that's the beauty of it. I'm in just to help you, but I don't want you to spend money on something you don't need. You're not going to do that. I'm not going to allow that to happen. I'm only going to make sure you get what you absolutely need, and nothing, nothing more. I'm not looking to sell you something. Let's put it that way.
So when it comes to, as you mentioned, some like these like free services and different grants and programs and things that are out there, sometimes say if it's free, you get what you pay for, right? And I guess maybe it's some things. Are there red flags or things to ask? Like, okay, this free advice is actually invaluable and it's well worth listening to, or how do I tell that something's, they really are being helpful, or I'm getting some random advice from some small dingy office for free?
Well,
that's good advice, but it's just
right.
thoughts on how to filter through some of that to go like, wow, that's good, right? Red flags that I should be looking at.
I mean, if I think we can often see through it. Like I said, I wouldn't keep saying my experience and what I've heard from people that have used the small business development centers have been good. That doesn't mean they're all good and all offices are good. Sometimes if you get advice and you think this does not sound right, then it's worth doing a check. And I'm happy to talk to somebody if they get advice and they think, man, this sounds like a whole lot of baloney. Then I'm happy to talk to them about if it's financial advice, free financial advice. It sounds like it's a little off kilter, shall we say. I'm happy to do that. And again, you've got a really good veteran network. There's a whole lot of good vets out there that are willing to help. But I think, again, if it doesn't sound right, then bounce it off somebody else. And I'm happy to be the person to bounce it off as well, just to say, okay, that free advice is a little suspect.
I guess when it comes, that's a good point. And it's one of the things I find one of the benefits of being a veteran to go through, like joining these different groups that are out there and to ask, right? I guess if it's like, as someone's used services or had success in using services, so that you actually don't walk into it cold and you're like, okay, I know a few people who've actually used this office or this particular person, and they give out good advice. I mean, it's interesting. I know there's some that it's almost like they're just doing it and they want to have a program, but other people are coming from their heart that they're just giving back, and that's something that they want to do in their life. They made it and want to make, that's something that they want to do, and their advice is solid, right? They could be charging for it if they wanted to, but that's not the way they operate, which is great that those people exist.
Oh, we all know referrals from a trusted source go a long way towards making us feel comfortable. So that's part of it for sure, is referrals. And that's kind of the beauty of Local Vest and of 10X Vets, those areas, because you feel very comfortable referring. And again, I would say the trusted advisor, whether your financial advisor, your fractional CFO, whoever's helping you raise capital, you just want it to be a trusted advisor where you feel very, very comfortable going to them and asking them questions. Or again, I'm happy to be somebody who can bounce things off of if you kind of think that the advice is suspect. And usually you can tell, but it's not always possible to tell. If it sounds like it, if it sounds too good to be true, it is, right? I mean, that's really true, especially when it comes to finances.
I guess, do a lot of them have a background? In other words, have they been there and done that before, did you find?
I think so. A lot of times they might have a like a veteran or entrepreneurs who volunteer to help. So I think they're usually pretty vetted. That doesn't mean they're always going to be good, but I think as a general rule, they try to make them, a good small business engine to help develop small businesses. So it's just like everything else. They're not always going to be perfect, but I believe they'll use entrepreneurs. They'll use different people who have expertise in starting a business, growing a business, writing a business plan.
All right, I know we have a question here, but I'll just go through with someone's very cash strapped. They're at the very beginning to go through. How do they get advice from someone like you or going through and then delay the payments until you've got the cash? Are there ways to do that?
Delay the payments till you got yeah, that would, that might be
Just
a longer.
asking.
Yeah, that's a long, well, and again, I think you can negotiate too. You have to negotiate, and always, you know, sometimes people will, and I'm not saying anybody's doing that, will run and hide when it comes to I can't pay my bills. But a lot of times they say, hey, look, I'll have it, or I'll give you a little bit of it here and there. And I think most businesses, cash strapped, will say, okay, well, let's come up with a payment plan of some sort. I mean, there's a way to do it. There's a way to work it out. And just the fact that you're going to pay them, even if it's later, I think it's better than not getting paid at all. Having been in business for a long time or helped run businesses, it's at least if you have the money's going to come in, it comes in later. It's better than never seeing it and never hearing from the person. So I think there are ways to negotiate that and make that work. And sometimes you might, depends on what it is. It may not be in a situation you can barter for services as well. There are sometimes you can do that. There are grants. The other thing I didn't mention was partnerships. Depending on what your business is, you might be able to come up with a partnership. I know somebody that I worked with had a partnership with Amazon Web Services, and when they sell, they get a certain amount of economies of scale or a certain amount of customers. Then Amazon Web Services will give them a grant of a couple $1,000s a month. So there are a lot of ways to do it, for sure. But I think getting paid, as I said, is always better, and even if it's later than not getting paid at all.
Understood. So you've had the chance with CFO Vets, several different companies come in through here over the last couple of years. When you look back just generally, you can call it Scott's pet peeves, or I guess in a more positive light, if you were saying like, wow, I wish I could tell all these people before they call me on there, what types of things continually come up that you'd like to tell a bunch of people who are out very early stages, very low cash flow, to look out for and try to correct it before it gets too late?
Yeah, I mean, always get more cash than you need. Get credit before you need it. Do all those things. Take care of that as much as you can in advance. So that's one thing. Again, and there are a lot of, I said there, you want to find trusted advisors to people that you can trust and bounce ideas off, and that'll give you an honest answer that will not just head nod whatever your idea is. So I think and again, that's, to me, that's part of what a CFO or a business is for, as well as what I do. Is I have to give the honest answer. I have to be the honest broker in the room and go, do you really want to do this? Because this may not work. The other thing I always tell people, here's one of my, it's not a pet peeve, it's just really good advice. It's, look, if your business, you start out with one idea and it doesn't work, but you have another idea, it's okay to not continue on the path of one singular idea. Once you realize it's not going to work, you pivot and do something else. That's the beauty of being a small business, is you can pivot and make changes. You do not have to stay the course. And then again, as veterans, we'll stick to it because we know we can get it done. There's some point you go in business, hey, this is not working. Let's do something else. Let's try something else. Let's be flexible and malleable, because that is a huge advantage to be in a smaller business than being a big business. It's like turning around an aircraft carrier, right? It's a lot harder.
Very true. So when you talk about, and there's a lot of discussion about the cash flow, I guess, are there some ways that you could think, even though these are smaller companies to go through, about how to maximize your cash flow or reserving your cash? Are there some different tools you can think in effect when there's not a lot of revenue coming in?
Yeah, I mean, if borrowing, slowing down I hate to say this, slowing down your payments or coming up with a payment plan, you pay it a little bit slower, using credit cards so you don't have to, so you can maximize your float. That's a good way to do it. Find the best plan. There's a lot of them that have good cashbacks too, that can help you, have really good cash back that's instantly, and then that refills your coffers a little bit. So, those are some way to do it. And again, it depends on the business. If you're in a subscription or a software as a service business, then you're probably in a little better shape because you're probably getting paid as you go. If you're providing services or consultative services, like a lot of businesses I've been in, you often get paid after the fact. So it's even more difficult to deal with that. But you just have to be very creative. You have to think any way that you can to kind of slow down the outflow and maximize the inflow as much as possible. And it gets to be tough and tight and shoestring. And that business I told you about, the controller, the one in Texas, we had chronic cash flow problems. And I tell you, we had 11 bank accounts. It was constantly juggling for $100 million business. If you can imagine how difficult that was. You're doing it on a smaller scale. You're doing the same type of things with less money. And again, it's like your personal financial situation as well. How can you juggle it? Hold on to your cash as long as possible, and then stop the outflows. You just have to be very creative about it.
I think I'll put a plug in for that one too, just to say here to build on what you're saying of, it's one thing to set the price, but that cash flow becomes important about how you get paid. And so sometimes it's a matter of talking to other essentially looking at what your competition may be doing, or maybe you do something that your competition is not doing. When it comes to that idea of like, it's not the price point, but getting paid in installments, discounts to try to get paid early. I mean, if it comes down to like you are in a cash crunch, that float, it will not save you, right? Because all you're doing is shifting cash around in some ways. But I mean, if you're at that stage where it's trying to keep you alive to go through and be able to do a raise, some people ask how long does it take to do a raise, and we'll talk not about that today, but it can take longer than you think. So you may need to adjust those. Just, I guess, a balance of look at your float and your working capital and how that goes, but then also that warning of that is, no one's ever built a huge, massive business on managing their, days of working capital, right? It's essentially biding the time. It doesn't work. Again, it's like you say, it's a cash management tool, not a company growth tool.
Yeah.
So, right. But an important one to not to forget about, like I say, you put it out there and goes, and then I'll provide all these services and hope 6 months from now I get paid for everything and then everything's going to be okay. There are ways to try to manage along the way if it's really tight for you.
Yeah, I mean, discounts for early payments for sure, particularly if you're dealing with large companies who will cash flow. Fortune 500 cash flows the rest of us. I mean, they do it. You're an Exxon guy. You probably know that very well.
We did it earlier, but I also, that's my other plug they're going through. Be careful with the big companies. It sounds glorious. I can tell you on the other end, they don't care, right? So you want that big deal, but that big deal, you could win the big deal. They'll be smiling at you go through, and it could take 6 months to get. I mean, it could take, you may go out of business before you actually get paid. So big companies with big names aren't necessarily the heroes that you think they could be if you're not careful, right? You understand how that goes.
Especially,
they'll put in there like government stuff too. Exactly. It can be rough, right? Because you go like, hey, if I don't get this, I'll shut down. And that person you're telling that to has no power to do anything about that. I mean, they could be crying with you, but cannot push the button to say pay you. So it's just something to keep in mind as you go. Don't put all your reliance on government contracts or the big ones. Make sure you try to as many as you can.
Yeah, I mean, it's customer concentration, a large customer concentration. One big client is very risky, obviously. That's so, as always, and then people say, I don't want to do that. So ask for money up front. Ask for it up front. Ask for some of it up front anyway, if you can get it. You'll never know if you don't ask. That's another way. Terms, discounts, if you actually have a little bit of receivables, if you have to factor them and let somebody take a piece of it, but get the money up front, I know some firms that do that while you're waiting for, get paid by the contract. There's ways to do that as well. There are a lot of pieces to it, but in the end, it can be very tight and a harrowing experience for sure. But I agree with you. I think that's a very good thought, is that large companies are not a panacea. You get them and they're not necessarily a panacea for growing your business. You always want to have a diverse customer base as you grow larger and not have a client concentration problem, for sure.
Right. Well, I know we're getting here towards the top of the hour for us, so I wanted to take the time to say thank you, Scott, for being able to come in here and chat with us. I mean, we only, the tip of the iceberg on different topics, right? I know we made some of them sound very easy for all, like that sounded great, right? I mean, there's a lot to it. I know each of you have unique businesses. We didn't get to all of the questions that are in the screen there, but let me share my screen again in here, because I wanted to be able to put up for everybody. Moment here. So when it comes to Scott, it's here on the screen, but you got your email address, you have the web page cfoforvets.com. You can find him on LinkedIn and join up with him there. And he's even got his phone number there. You're going to get an email that has his contact information here, but I also wanted to remind people about office hours and the way they work. So how you book office hours, all of you are going to get an email later on today. So if you participated in the webinar here, even those who weren't able to attend the entire thing, they're going to get this. Just like you had in school, there are times a lot of places are doing office hours. This is your chance to get one-on-one time with Scott. So if you get your question answered, or I know some of you may have some, call them more sensitive questions that you want to ask him on a one-on-one setting, you can do that. There are 3 dates. We got the 19th, the 22nd, and the 26th. All of them are 1:30 to 2:30 Eastern time. Hopefully one of those time blocks works for you. And I'll be monitoring how popular these are. But there are 15-minute blocks. So in that email, you have a link to a Calendly forecast from events@localvest.com. And so you can pick one of those blocks, and it shows you if you need to move that around and do it. It's going to send you an invite to do a Zoom meeting, and you'll be able to get in there and ask those one-on-one questions, determine if you can get your question answered, or if you need to take the conversation further with Scott and CFO for Vets. All right. That's when it comes to here.
Jake, are they free,
yes.
or is there a cost for these office hours?
Those are free. Those are absolutely free. It's a part of being a part of the program here. All right. And as I said, for those who aren't behind, this is one part of the pre-deployment program, including the office hours. We're going to continue to meet like this monthly. I am about to firm up. The person is going to be able to come in for the month of August. I've had a few conversations today, and when we get that, we'll be able to lock in the actual time for the event as well. So sometime in the mid to late month, working it with the rest of our Local Vest calendar, which is actually filling up. We've got a few different activities that are going. Launch with Local Vest that we go in here, especially we got the summer months. I know a lot of people off taking different travel opportunities. So keep looking for your emails, keep looking. We'll be sending some more out when it comes to pre-deployment as well. The other part too is if there is a particular topic that you would love to get answered, or something that we should address, feel free to send a note to me on that. Lots of different ways to be able to do that and reply out in there, because that is something that we're looking for. As I said, part of the program involves us knowing what you need. So if it's more legal advice, intellectual property, more financial advice, something that I'm not even listed, you want to understand partnerships and deep dive on one of those, we can absolutely do that. That's the whole point of this. The safe zone, you can ask the question. That's what we're looking to help you out with. All right, so feel free to let me know. So with that, we are at the top of the hour. So thank you all for joining. And be looking for those emails, sign up for the office hours and for our next event that we'll have the next month as we kick off the pre-deployment program. Thank you all for joining.